Good morning. Hard money loans. When do they make sense? And when to use a non QM loan instead? So, hard money loans have a reputation for being fast, flexible, and expensive. And all three are true. But the real question most buyers and investors should ask is this: when does a hard money loan actually make sense? And this flip side of that is, when should you pivot to a non QM loan instead? And the answer is really it's designed especially for owner occupied properties, but there's a number of non QM options for investments as well. And in Medallion funds, we guide borrowers through both options every week. And here's how to think about them so you avoid overpaying or getting stuck with the wrong loan strategy. So, what is a hard money loan? Very simple definition for a fifth grader. A hard money loan is an asset based real estate loan funded by private lenders or capital. Instead of focusing really on credit score and income, they're focused more on the property value relative to the loan advance. I think the key metric there is the loan to value or LTV. But not only that, they're really going to look at your exit strategy and your liquidity. And these loans are really known for these kind of uses. They're lightning fast closing. And lightning is in quotation marks, but there's flexible underwriting and minimal documentation, and funding deals banks won't touch is really the key concept. So that's their space and that's what they're good at. But also, here's the downside. You're looking at higher rates, 10 to 15%, shorter term, 6 to 24 months, and significantly higher fees than a traditional type loan. And hard money works exceptionally well, but you really only need to use it in the right scenarios is really the takeaway I'm trying to get across here. So when hard money loans make sense, and this is when you should prioritize that use. Number one, when speed is everything. If you need to close a deal in 10 to 15 days, no bank or traditional lender can compete with private capital like that. So here's some examples that it could be used for. So auction properties. And you really don't ever want to get a full-blown loan from an auction property. So distressed seller situations when they need quick funding, when you've got an assignment or a wholesale flip going on, or when there's competitive investor offers and you really need to close quick. Speed creates leverage for the buyer or the investor, I guess, but they're both buying. And hard money is always going to win in that category is the takeaway. Number two, when the property won't qualify for traditional financing. So hard money is ideal for homes that need a foundation repair, major structural issues, like a roof replacement, a major plumbing or electrical work, or if it needs extensive renovations. Or here's another category too, income properties with low occupancy, negative cash flow even. And you can use projections in both of those situations. An incomplete leasable area, so if you need to go in and renovate. So traditional lenders want clean and stable, but hard money lenders fund ugly but profitable. And that's the real distinction there. When investors need a bridge to stabilization, so BRRRR investors use hard money strategically, and that's the way you should think of this. You want to buy, you want to rehab, you want to rent it out, you want to refinance the property and pull cash out. And here's the fun one, repeat it. BRRRR. Hard money fills the gap between acquisition and refinance. And as long as the numbers support the exit, you'll make money is the real takeaway there. Number four, when creditor tax returns are complicated, and this happens more often than you'd think. Hard money lenders only focus on the collateral and not the borrowers. They're really not concerned with your taxes. And it's a good fit for self-employed buyers who write everything off. Investors with heavy write-offs, that's another category. And people with recent credit events that might not qualify for traditional bank financing. And also income that's not going to fit into an agency DU or LP rules. In these cases, non-QM may also work, but hard money is going to close significantly faster, and that's the takeaway. And here, this next segment is when you should not use hard money. So everything has a place, but here's when you want to avoid hard money. Number one is owner occupied residential properties. I'm sure there's some folks out there who will do them, but most won't. Hard money lenders avoid owner occupied homes because they trigger consumer protection compliance rules and can slow down a foreclosure in the event that you default. Now, in these cases, non QM loans are the correct path. Non QM loans, the smarter alternative for owner occupied borrowers. When a borrower needs a non traditional loan to live in a property, non QM is almost always the better fit. And you may ask why. Well, it's going to have lower rates than hard money, so I think that makes it a little bit more attractive. Generally, there's going to be a longer term where you can get a full 30-year fixed amortization. And they will look at credit as well as asset-based underwriting programs, and you can use bank statement loans for self-employed. There's no DTI requirement options, or no firm DTI requirement options that they can use alternative income. And it's great for cash flow-based loans for rental. So you can use hard money for fix and flip or investor acquisitions, but think using non-QM for any owner-occupied purchase or refinance options. And choosing the right strategy is important, and that's why Medallion Fund's approach is a little bit unique. We help clients with both hard money and bridge loans for investors, as well as fix and flip, and for the BRRRR strategy folks. We also fund ground up construction for subdivisions, projects, and single one off ground up construction projects, but also commercial and mixed use. And we have flexible underwriting. So non QM loans, both owner occupied and investor, are some of the products we offer. We offer bank statement loans, P&L only loans, which are really helpful sometimes, and also asset qualifiers, which really just, there's no income shown, it's just bank accounts. But debt service coverage ratio loans, 1099 loans, loans for self-employed, and there's also a lot of jumbo non-QM projects that have products that have higher DTI requirements, so that's a good fit as well. But no matter the scenario, we're going to match borrowers with the right product, not the most expensive one. And that's what we're here for. We save you money too. So the final takeaway here is hard money is a powerful tool when used as a tool and not as a default. Non-QM is the upgrade for owner-occupied buyers who need flexibility without paying hard money rates and fees. Now, if you're unsure which direction your deal fits, that's where we can step in. Book a call today with Medallion Funds and we'll structure it the right way the first time around. You can visit my site, billraponline.com, to schedule a consultation. As well, there's free tools. Thank you for your time. Have a good day.